A fixed cost, abbreviated FC, is a cost that does not change with the level of output in the short run. Think of the monthly rent for a bakery's storefront. Whether the baker bakes 0 loaves or 10,000 loaves, the rent stays the same. A variable cost, abbreviated VC, moves directly with output. In the bakery example, flour, sugar, and electricity used to bake each loaf are variable. Double the number of loaves, double the flour cost. A mixed or semi-variable cost contains both a fixed component and a variable component, like a phone plan that has a base fee plus a per-minute charge. MC equals FC plus V times Q, where V is the variable cost per unit, and Q is quantity. The key distinction is how the cost behaves when Q changes. FC is flat, VC is a straight line through the origin, and MC is a straight line that starts above the origin because of its fixed part. The total cost TC function adds all costs incurred at a given output level Q. Using the notation above, TC of Q equals FC plus VC of Q. If VC is linear, VC of Q equals V times Q, so TC of Q equals FC plus V times Q. The average cost of C functions divide TC by Q. The average total cost of TC is a TC of Q equals TC of Q divided by Q equals FC divided by Q plus V. The average fixed cost of FC is a FC of Q equals FC divided by Q and falls as Q rises, because the same fixed bill is spread over more units. The average variable cost of VC is a VC of Q equals VC of Q divided by Q equals V, constant if VC is linear. The marginal cost MC is the derivative of TC with respect to Q. MC of Q equals DTC divided by DQ. For a linear VC, MC equals V, a horizontal line. If VC is nonlinear, VC equals a Q plus BQ squared, then MC equals a plus 2BQ, which rises as output grows. These functions give managers the tools to see how each cost component behaves per unit, and how an additional unit affects total spending. Graphically, the TC curve starts at the vertical intercept equal to FC and slopes upward as Q increases. The IFC curve is a hyperbola that declines rapidly at low output and flattens out as Q gets large. The IVC curve reflects the shape of the variable cost component. If VC is U-shaped, common when marginal product first rises then falls, IVC will also be U-shaped. The ITC curve is simply IFC plus IVC, so it also tends to be U-shaped, sitting above IVC because it adds the fixed cost burden per unit. The MC curve intersects both IVC and ITC at their minimum points, a crucial property used for profit maximization. When MC equals MR, marginal revenue, the firm is producing the profit-maximizing output. For a bakery, if each extra loaf costs 30 cents in ingredients, MC, and the market price is 50 cents, the bakery should keep baking more loaves until MC rises to 50 cents, perhaps because overtime labor starts to kick in, making MC increase. The break-even point BEP is where total revenue TR equals total cost TC. Using price per unit P and quantity Q, total revenue equals P times Q. Set total revenue equal to total cost. P times Q equals fixed cost plus V times Q. Solving for Q gives break-even point equals fixed cost divided by P minus V. The denominator, P minus V, is the contribution margin per unit, the amount each unit contributes to covering fixed costs after variable costs are paid. In the bakery, if a loaf sells for $2, variable cost per loaf is $1.20, and monthly rent fixed cost is $3,600. The contribution margin is $0.80. Break-even point equals $3,600 divided by $0.80 equals 4,500 loaves. After 4,500 loaves, every additional loaf adds $0.80 to profit. This analysis is simple yet powerful for deciding whether a new product line is worth launching. In the short run, at least one factor of production is fixed. For example, factory size, major equipment. Therefore, fixed cost exists and cannot be altered without incurring large adjustment costs. Decision makers focus on variable cost and marginal cost when choosing output because fixed cost is sunk for the period. In the long run, all inputs are variable. Firms can change plant size, enter or exit markets, and fixed cost can be altered. Long-run cost curves are derived from the envelope of the lowest possible short-run average total cost curves for each plant size. This is the long-run average cost curve. The long-run average cost shows the minimum cost at each output when the firm is free to choose the optimal scale. A manager deciding whether to expand a bakery to a second location will compare the long-run average cost at the higher output level with the projected price. If long-run average cost lies below price, expansion can be profitable. If not, staying at current size avoids losses. Cost-volume profit CVP analysis extends break-even point by incorporating multiple variables: sales, price P, variable cost per unit V, fixed cost FC, and target profit pi. The general formula to find required sales volume Q star for a desired profit is Q star equals open parenthesis FC plus pi close parenthesis divided by open parenthesis P minus V close parenthesis. Sensitivity analysis changes one input while holding others constant to see the effect on Q star. Example: if the bakery raises the price to $2.20, the new break-even point becomes FC divided by open parenthesis 2.20 minus 1.20 close parenthesis equals 3,600 divided by 1.00 equals 3,600 loaves, a reduction of 900 loaves. A CVP table can list different scenarios: price changes, cost reductions, cost plus pricing, and their impact on profit. The underlying mathematics assumes linear relationships if variable cost per unit changes with volume, for example bulk discounts. The model can be adjusted piecewise, or by using a quadratic VC function, leading to a quadratic equation for Q star. When a firm economies of scale are present, average costs fall as output rises because fixed costs are spread over more units and operational efficiencies. Specialized labor, bulk buying, reduce variable cost per unit. For the bakery, buying flour in a larger bulk contract may lower the per loaf flour cost from 0.30 to 0.25. Economies of scope occur when producing multiple products together is cheaper than producing them separately. For example, the bakery can use the same ovens to bake both bread and pastries, sharing fixed costs. Diseconomies of scale arise when the firm becomes so large that coordination problems, bureaucracy, or overuse of equipment raise average costs. A large bakery chain might experience higher transportation costs per loaf or slower decision-making, pushing average total cost up beyond a certain output. The LRAC curve typically is U-shaped. The declining portion reflects economies, the flat portion reflects constant returns, and the rising portion reflects diseconomies. Understanding where the firm sits on this curve guides expansion decisions. Explanation. Sample exam question 1. A firm faces fixed cost equals $10,000, variable cost equals 5 times Q plus 0.02 times Q squared. The market price is $25. A. Write the total cost, average variable cost, average total cost, and marginal cost functions. B. Compute the profit maximizing output. C. Determine the break-even quantity. Solution strategy. A. Total cost equals 10,000 plus 5 times Q plus 0.02 times Q squared. Average variable cost equals open parenthesis 5 times Q plus 0.02 times Q squared close parenthesis divided by Q equals 5 plus 0.02 times Q. Average total cost equals total cost divided by Q equals 10,000 divided by Q plus 5 plus 0.02 times Q. Marginal cost equals the derivative of total cost with respect to Q equals 5 plus 0.04 times Q. B. Set marginal cost equal to price. 5 plus 0.04 times Q equals 25, which implies Q star equals 500 units. Verify that price exceeds average total cost at Q star. Average total cost equals 10,000 divided by 500 plus 5 plus 0.02 times 500, which calculates to 20 plus 5 plus 10 equals $35, which is higher than the price, indicating a loss. Actually, profit maximization with price less than average total cost means shut down in the short run. The highest profit is at Q equals 0. C. Break-even point. Set total revenue equal to total cost. 25 times Q equals 10,000 plus 5 times Q plus 0.02 times Q squared, which simplifies to 0.02 times q squared minus 20 times q plus 10,000 equals 0. Divide by 0.02 to get q squared minus 1,000 q plus 500,000 equals 0. Solve for q. Q equals 1,000 plus or minus the square root of 1 million minus 2 million, all over 2, which gives a negative discriminant, so there is no real break-even point. The firm cannot break even at this price. Sample exam question 2. Explain how the long-run average cost is constructed from short-run average total cost curves, and discuss the managerial implications of operating at a point on the rising portion of the long-run average cost. Answer outline. Plot short-run average total cost for several plant sizes. The long-run average cost is the lower envelope of those curves. Operating on the rising portion indicates diseconomies of scale. Managers should consider downsizing, improving processes, or adopting new technology to shift back to the flat or declining portion. These examples illustrate how to translate algebraic manipulation into economic insight, a skill frequently tested in MBA exams.